Do you want to leave as much of your estate as possible to your heirs after you pass away? And if so, then you might be wondering, should you be giving gifts away on your deathbed as a good way to help you maximize your taxes on the assets that you want to pass on? Guys, in today's video, I'm going to be breaking everything you need to know about deathbed gifts and whether or not they can help you reduce taxes for your heirs. In fact, giving gifts to your heirs before you die can actually cause them to owe more in taxes, not less.
God damn it! What?
Please make sure you stay all the way until the end of this video, because making mistakes with your estate planning can cause Uncle Sam to tax your heirs' inheritance much more than you actually might like. Let's dive into this video. All right, guys, let's cover this. What are deathbed gifts? You see, deathbed gifts are last-minute gifts that people try to give to their heirs very soon before they die. There are a wide variety of assets that are commonly given as deathbed gifts. This can include houses, cars, jewelry, artwork, collectibles, cash, and even land. But these gifts are frequently made from a parent to a child or a spouse. However, this is not always the case. A person might give assets to a friend, they might get assets to a cousin, a charitable cause, a grandchild, through a deathbed gift. And there are a number of reasons why a dying person might want to give deathbed gifts. For example, a person may have never created a will, and so he or she might want to try to divvy up the assets before it's too late. Or even if a person does have a will, he or she might have forgotten to include certain items in the will. So a person could also have acquired more assets after they created the will, and therefore the items are not included in the will. And finally, a person might give a deathbed gift just in an attempt to help their heirs pay money for taxes. Now, can deathbed gifts actually help your heirs save money in taxes? For the people who want to use deathbed gifts as a tool to help their heirs save money in taxes, it's primarily an estate or inheritance tax that they're hoping to reduce. So the thought behind deathbed gifts is usually this: if I can make my estate smaller by giving some of my assets as gifts to my heirs before I die, I can then help them avoid inheritance or estate taxes later on. But I'm going to let you know right now, in the vast majority of cases, guys, this is actually not true. In fact, giving gifts to your heirs before you die can actually cause them to owe more in taxes, not less.
God damn it! What?
I know, it's crazy, right? Let me explain this. So in order to know the deathbed gifts can help your heirs save money in taxes, there are really two main variables that I want you to take into consideration. Variable number one is the size of the estate. The size of the estate in question is extremely significant because the federal estate tax only applies to estates that are worth at least $12.92 million for individuals or $25.84 million for married couples in 2023. So right off the bat, if your estate does not meet these thresholds, then you will not have to worry about federal estate taxes. The majority of estates do not meet this threshold. Therefore, deathbed gifts will not help people with smaller size estates to escape the federal estate tax because they won't have to deal with it in the first place. Now, variable number two is the state that you live in. You see, the state that you live in also impacts whether or not deathbed taxes can save you money in inheritance or estate taxes. And the reason why is because only some states impose their own inheritance or estate tax. Most do not, but there are 12 states that impose estate taxes in addition to the District of Columbia. And there are 6 states that impose inheritance tax. Maryland imposes both of these taxes. Now, if your state does not impose estate or inheritance taxes, then again, deathbed gifts are not going to help you save money on inheritance or estate taxes because you won't owe them in the first place. Now, let's talk about why deathbed gifts don't really save heirs money in taxes. The main reason why deathbed gifts usually do not help heirs to save money in taxes, besides the facts that many people don't own estates or inheritance taxes in the first place, is due to something called step-up in basis. Step-up in basis is a tax rule that states when heirs inherit assets, the fair market value of the asset at the time of the descendant's death is used as the cost basis for the asset, not the original price that the grantor bought the asset for. So in this way, the cost basis is stepped up to the current market value. That is why it's called the step-up in basis. Guys, the rule has enormous tax implications and specifically pertains to capital gains taxes. For many assets that are passed from one person to another at the end of their life, you don't want to have to pay taxes on that. But when an asset is stepped up in basis, the person who receives the asset does not have to pay capital gains taxes on the asset's appreciation that occurred before he or she receives it. However, if an asset is not stepped up in basis, then the person who receives it will have to pay capital gains taxes on the appreciation value that the asset experienced when it was held by the previous owner. So if an asset is given to a beneficiary before the person giving the gift dies, then the asset does not get the step up in basis. However, if an asset is given to an heir after the person dies, then the asset is stepped up in basis if it is in a trust. So to understand how this works, imagine that you have an uncle and he bought a $50,000 house that's now worth $500,000 and he wants to leave you the house. If he gives you the house before he dies, then there would not be a step up in basis if he gifts it to you. Therefore, you would pay capital gains taxes on the $450,000 that it made over the 20-year period that he held it before he gave it to you. This means that you could have to pay an additional $90,000 in taxes just for this asset alone. However, if you received the house after your uncle died, and if he had it in a trust, then you would get the step up in basis. It would be stepped up to $500,000. This would enable you to skip around that $90,000 of capital gains tax on the $450,000 of appreciation that occurred during your uncle's lifetime. Because of this step up in basis rule, it makes it much more of an appealing way for people to build wealth and to pass on assets to their heirs versus gifting assets. But also keep in mind that step up basis rules do not apply to every asset. They do, however, apply to real estate. They apply to artwork, individual securities, businesses, mutual funds, ETFs, and collectibles and furnishings. Some assets that don't get a step up in basis are your 401ks, 403bs, traditional IRAs, Roth IRAs, and tax deferred annuities. So here's something I want you to understand. There's a lot of people making major mistakes. And unfortunately, people are unaware that the step up in basis rules are there and they start giving valuable assets to their heirs right before they die. For example, a father might pass along stocks, artwork, rental properties to his children weeks before he dies. He might think he is doing the right thing and reducing taxes for his children, but he could actually be causing them to have to pay an additional 15 to 20% in capital gains taxes that they would have otherwise not had to pay if the father would have had a trust and the children would have had the assets in the trust that got passed on to them. So in other words, in an attempt to save their heirs money and taxes, many people actually end up causing them to dramatically increase their tax bill. So if you are doing your estate planning now, or you're thinking about potentially getting into estate planning or gifting to your heirs, then I strongly consider speaking with a tax professional or an attorney who specializes in estate law, making sure that you're not making any financial decisions that could hurt your heirs down the road. But what happens, Karlton, if I've already transferred assets to my heirs? You see, sometimes people transfer assets to their heirs before their deaths in an attempt to reduce taxes, but then realize that they made a mistake. Or maybe you're just trying to help your child out. Once they realize they made a mistake, they might want to try to remedy it by trying to gift the asset back to their estate. The good news is that this is actually possible in some cases, especially when it comes to real estate. The reason why assets can sometimes be placed back into an estate is due to a tax principle called retained interest. Retained interest is just an interest in a piece of property that is kept or retained by the grantor even after his or her ownership of the property is transferred during his or her lifetime. So a good example of retained interest would be if a woman transfers the ownership of her house to her daughter before her death, but continues to live in the house rent-free until the time of her death. You see, in this case, the argument could be made that she had a retained interest in the property until her death. Therefore, the IRS might allow the house to be placed back into the estate. Then the child who owns the property could then potentially get that step up in basis once the woman's death occurs. That means that you avoid the massive capital gains taxes that would have had to been due within 6 months of the date of death. So in some cases, assets that have already been gifted can be placed back into estates to reduce taxes. But that doesn't mean that you should test your luck with this strategy. This doesn't always work, and it is far safer to just avoid giving away assets as deathbed gifts in the first place. Now, I wanted to mention something about an annual exclusion. Even though it is generally better to leave assets inside of an estate to save on taxes, there's a tax rule called the annual exclusion that you should be aware of. The annual exclusion is the amount of money that you can give as a gift to people per year without this money being subject to gift taxes. For 2023, this amount is 17 grand for individuals, 34,000 for married couples. All this means to you is that you can give up to $17,000 to a person without the gift being subject to taxes if you give it to an individual. If you give a gift as a married couple, this jumps up to $34,000, double. Also, this limit applies per person per year. So let's just say grandmother wants to give $17,000 to each of her 10 grandchildren in a year, under the exclusion laws, she could do this gift, but it's going to trigger estate taxes. So that means that if you want to give gifts with this level of value or less on your deathbed, then this could be a scenario in which it could actually be a good idea. But for many valuable assets, it is generally better to keep them in your estate so that they can be stepped up in basis. Also, keep in mind that you don't have to wait until you are at your deathbed in order to give these gifts tax-free. In fact, when you reach later years of your life and when you are ready to start passing on wealth to your heirs, you could start giving away $17,000 per year to your heirs. So for example, let's just say that you have 2 children and you decide to start passing down wealth to them when you're 70 years old. You could do this. In this case, if you lived another 10 years, you would be able to give $170,000 to each of those children tax-free over the course of 10 years through the annual exclusion rule. Now, this is a strategy that many people use because it's so convenient and it can help you save more money in taxes if you have other assets that are pushing your estate tax up. What happens if you do not make deathbed gifts and if you don't have a will? Some people unfortunately die before they make any deathbed or any end-of-life gifts, and they do not leave behind a last will or a testament. If you die without giving away assets through deathbed gifts or through a will, then you might not be able to guarantee that the assets you want to leave behind will end up with the people of whom you want them or intend them to be left with. In fact, if you die without a will, your estate will go through what's called the probate process with the local probate court. You may not even like the local probate court. The court will follow the succession laws that are in place, and these laws determine who will receive your assets after your death. Typically, these laws prioritize a surviving spouse or domestic partner, followed by children, then parents, then siblings, then extended family members. But here's the thing, the probate process in which the court evaluates your estate and then divvies up the assets can take months. This can be especially difficult on your family who will still be grieving your loss and then has to pay taxes on your estate. The stress of the probate process is one of the main reasons why you should completely finish your estate planning well before you reach the end of your life. Yet, despite my efforts, the critical importance of efficient estate planning might surprise you to know that astonishingly roughly 2/3 of adults in the United States have no will. I had to say it. Guys, you are putting your family in danger by doing this. Guys, you can save your family a lot of difficulty if you finish your estate planning before you die. You can also make sure that your assets are distributed how you want them to be through the proper estate planning as well. That's why we work so hard. So if you haven't finished your estate planning yet, guys, and if you don't have a will, you should strongly consider taking care of this. Matter of fact, you should take care of it right after this video. Now, what should you do instead of making deathbed gifts? You see, as I mentioned earlier in this video, for most people, simply making a will and passing on assets to your heirs through your will and your trust is a good strategy, especially if your estate does not meet the threshold for the federal estate tax and you live in a state with no inheritance or estate taxes. But using the annual exclusion rule can give you up to this additional $17,000 per year that you can dish out to your heirs. That's a great way to pass on some wealth and save some money in taxes in the process of doing your estate planning. However, many people also prefer to use trusts to assist with their estate planning. Trusts have many great benefits that can be extremely helpful to you when you're doing your estate planning. Here are some of the key benefits of setting up a trust to help you distribute your assets to your heirs. Number 1, they can help your heirs to completely avoid the probate process. I believe this is the number 1 reason why most entrepreneurs or those of status get trust. They want to avoid the probate process on their heirs who are receiving their assets or their businesses upon death. Number 2, they can help to protect your privacy. Unlike wills, which become a part of the public record, trusts don't do that, okay? So if you want to optimize your privacy and keep the details of the assets that you're passing to your heirs a secret, a trust is a better option than a will. Number 3, they can provide tax benefits. And when I say that, I really want you to understand this. Many types of trusts are not subject to estate taxes, so this can be extremely helpful for you. And number 4, they give you extra control and security. You see, with a trust, you're able to exercise a large degree of control over how your assets are distributed. And if someone tries to contest the distribution of your assets in the future through your trust, it is extremely difficult because trusts are under contract law and they're very, very secure. Guys, we've reached the end of this video. And as always, I want to congratulate you for making it all the way to the end. I do my absolute best to give you the most cutting edge information as it pertains to taxes and estate planning. I know we covered a lot of information, but here's what I want you to walk away from with this video. Number one, many people think that deathbed gifts can help their heirs to save money in estate or inheritance tax, but in most cases, this isn't true. In fact, it usually saves more money in taxes to just leave assets in your estate for them and then let them inherit it after your death. Number two, one of the main reasons why deathbed gifts usually do not help save money in taxes is because of the step up in basis rules. This is a rule that allows the cost basis of an asset to shift to the current market value once its ownership is transferred after the death of the grantor. And number three, if you would like to transfer some of your assets to your heirs before you die while optimizing taxes, you can do so through the annual exclusion rule, which lets you transfer up to $17,000 per year without having to pay the gift tax. So the bottom line is that it's generally better to not try to transfer the ownership of high value assets to your heirs through deathbed gifts. Unfortunately, many people get this wrong and end up accidentally placing larger capital gains tax burdens on their heirs. If you have any questions about deathbed gifts, estate taxes, inheritance taxes, or any other tax issues, then feel free to get in touch with my team by clicking on the link below in the description. You should also find a link to my tax alchemy course in the description as well. This is a course in which I teach you the top tax strategies used by the savviest and the wealthiest of Americans in the United States. I believe this information is meant to be shared, so I'm putting this course together to be able to give you access. If you want to optimize your tax savings, I look forward to seeing you inside of Tax Alchemy. Okay, that's it for today's video, guys. Thank you so much for watching, and I'll see you in the next one. Cheers.